Welcome to Season 1 of Better Vantage by Vanguard, a podcast series hosted by Custom Content from WSJ and Vanguard. I'm your host, Christine Kashkari, Editorial Director at WSJ Custom Programming. And I'd like to introduce my co-host in this series and the resident expert, Joe Davis, Global Chief Economist at Vanguard.
Thanks, Christine. Really excited about today's episode. We're going to hear from an expert who really can help us think through potentially harnessing 1 or 2% higher after-tax returns and some really exciting what he calls off-label tax-savvy strategies, that many of which I was not aware of, and I've been in the business for 20 years. So, Christine, over to you.
When you talk about taxes, usually people's eyes glaze over,
Yes.
but please pay attention because coming up is a lot of very useful advice from our special guest today, Joel Dixon, Global Head of Advice Methodology at Vanguard. Joel, welcome.
Thank you very much.
Tax efficiency is your expertise, and today's conversation is all about maximizing after-tax returns and minimizing costs. But actually, it's really all about managing or doing what you can control.
Often the things that are sexy and get all of the commentary are the things that probably matter a little bit more on the margin than matter from the high level. If there's one thing that people should focus on in terms of maximizing their after-tax returns or after-tax wealth or accumulating after-tax wealth, it is maximize tax-advantaged account opportunities. That, by far, makes the biggest impact, orders of magnitude more than other things. Other things are kind of tweaking along the sides. But whether you're just an investor with W-2 income and 401k, access to a 401k plan, or whether you are a high net worth investor that owns your own business and has all sorts of ideas for bequests and intergenerational wealth transfer and so forth, the first place is understand and use the tax preferenced kind of options or vehicles that are available for you.
So harness the tax code best to your advantage. That's sitting right there.
Absolutely.
I would like to tell you, you'll be proud of me. I'm at least passing that low bar of maximizing my contributions to my 401k.
Right.
So for a lot of people, that tax efficiency that you're talking about seems pretty obvious. But what do you think is the hurdle for most people in appreciating the numerous things that they can do that's under their control?
Yeah, the biggest hurdle for many is that there is just this pain of people paying taxes. They fill out their tax form and it's I have tax due. That actually can be a good thing at times because
Whoa. What do you think? The higher the number, the better the thing.
I didn't say that. All right. I didn't say that. However, oftentimes people think about tax efficiency and it's just like defer taxes as long as possible. That is the be all and end all. As long as you're doing that, you're in good shape. That couldn't be more incorrect in many cases.
Tell me more about that.
So, for example, when you think about it, in your case, Christine, you're thinking about you have a 401k. At some point, you're going to have to start withdrawing from that 401k, say in retirement, to maintain some retirement income pieces. Well, we have these things in kind of traditional 401k investing and IRA investing, required minimum distributions that right today at the age of 73, in a few years, it goes up to age 75, there's a certain amount that you are required to take from those accounts every year. And that is, for most people, taxable income, taxed at ordinary income tax rates. But if instead you were to start taking withdrawals from those accounts somewhat before you had to, there are many instances where your total lifetime taxes and after-tax wealth is greater by spreading that out. Because what can happen is if you continue to let it grow and grow and grow within the 401k, for example, and you get to age 73 or eventually 75 and you start having to take it out, it's possible that because the amount you have to take out depends on your account balance and your age, that you might be getting so much income that it's pushing you into higher tax brackets. Whereas you could have evened out your tax exposure if instead you would have taken some money prior to age 73 so that you're managing multi-year tax planning.
You make a compelling argument. What are some other things that kind of pull against, at least my understanding, conventional wisdom, right?
Why do we diversify an investment portfolio, right? We diversify an investment portfolio because we don't know what the market is going to deliver over the course of the next 5, 10, 30 years. And so we have different asset classes and we think about correlations and, blah, blah, blah.
Yeah.
Because we're managing that unknown. We know we're going to look back 20 years from now and sort of say, oh, I wish I would have had it all in whatever stock.
Yeah.
But we don't know that going in. Similarly, there is a lot of tax risk in the system. And while you may have an idea of where you might be in the future, you really don't know. And because of that, there's a similar argument to think from an investment vehicle standpoint, a contribution standpoint, how you're saving, to diversify that tax risk for the future, which in some cases you have accounts that are tied to future tax rates. And in other cases, you have accounts that are tied to current tax rates.
So you're talking like Roth versus typical.
Roth is tied. You contribute after tax dollars today, so you kind of, assuming laws don't change with it, which is always a big assumption, obviously, but you would lock in the tax rate that you're paying on that investment, and then in the future, you don't have to worry about where taxes are. That pays off in a world in which your tax burden is somewhat higher, or we can get into the details, but it's even the case that the tax rate could go down and you might be better off with a Roth approach. But that piece of it helps diversify that risk that tax rates might actually increase that you're facing. So having a combination of these different types of exposures to future tax rate risks.
So it's not one or the other. I always got to convert to a Roth, or I got to do, from your perspective, it's more diversified.
Well, and if you want to get even more advanced, no one should be all Roth. And
that sounds pretty. Is that controversial?
So if everyone were to do all of their long-term savings in a Roth, and the rules stay as they are today, when you're taking it out, you have no taxable income. Well, then what that means is that when you were making the decision to contribute Roth or traditional, and you're thinking, oh, I'm going to have a higher tax rate in the future, so I'm going to contribute to Roth. Well, now you don't. And so you should have gone back and you should have actually been in a traditional IRA or 401k. So there's this endogeneity problem of how you mix these investment vehicles together. People will talk about pre-tax dollars and after-tax dollars as the same thing, and they're not. If you're contributing the same amount of after-tax dollars as pre-tax dollars, that's actually a higher effective savings rate. So I'll give you the example here. For somebody under the age of 50 and can choose between traditional IRA and Roth IRA for contributions, current contribution limit of $7,000 a year, assuming you can get the deductibility on the traditional IRA. But $7,000 a year pre-tax is actually less money being saved than $7,000 a year post-tax or after-tax, because the tax equivalent amount of that tax deduction, so say you're in a, let's make the math easy, 30% tax bracket, or facing a 30% tax rate, $7,000 contribution to a traditional IRA, you're getting $2,100 of tax savings. But you can't contribute that $2,100 of tax savings in the traditional IRA because you've already hit the maximum contribution of $7,000.
How about on the asset side? Right, so the investment side, right? So I'm doing my 401k. I got some, balanced portfolio, but I have a little bit additional money. I have savings besides that in IRA. So I have a brokerage account, right? So I'm trying to save a little bit there beyond cash, right? Saving for spending. So how should I be thinking about taxes there?
There's certainly some things you can do. Again, I go back to by far the first thing, even in a case where you're finding you have a lot of, let's say you're lucky enough to have a lot of other cash flow and that you can fund other types of investments and so forth. Still, have you maximized the opportunities on the tax-deferred standpoint? So that's kind of still first question. That said, to the extent that you have money outside of tax-advantaged vehicles, then you start hearing these concepts of things like asset location or tax loss harvesting. Where there are strategies to use with taxable accounts or accounts of different tax character to potentially maximize or increase the after-tax return. So asset location, a good example of this, where, there may be a role for more or less tax-efficient investments to be placed in accounts where you can take advantage of that more relative greater or lesser tax efficiency.
The recommendations that you're giving are really tailored to what more of us can do and what is under our control. So I actually wanted to take advantage of being next to a tax expert. Sorry, Joe.
Tax guru. Hey, Joe,
Yeah, just lean over, shift the chair over a little bit.
She's actually leaning.
I know.
I heard that you were a self-identified tax geek, so my question would probably be simple for you. But for us, I have 2 kids, 6 and 4, and we've enrolled them each on a 529 plan with Vanguard, of course, and so that's where they've been since they were born. Auto increase 2% to reflect the federal inflation rate.
Yeah, this is where often I'll say, look, you're doing the right thing at the kind of macro level to set, your kids and your kind of saving strategy up for longer term success. If you want to fine tune it, that's fine. I actually don't think you need to. You're like 95% of the way there. I will say, though, that what you're highlighting is we have created so many different investment vehicles that are targeted to specific goals, right? And this is another way to take advantage of tax-advantaged opportunities, because 529 is a tax-advantaged account that everyone thinks of as being dedicated to education savings. I actually have a 529 plan in my name.
Were you getting like another PhD or something?
I know, exactly.
The reason for that is it's another tax-advantaged account that I can take advantage of. But what am I going to do with this money down the road? I don't know yet. What I do know is I'm getting tax-advantaged growth that I'm not paying for each year, which I would be if it were staying in a brokerage account.
Right.
I'm getting a bit of a tax deduction at the state level for the contributions. And you know what? It's going to go to my heirs at some point, and I will transfer the beneficiaries. And there are certain gift tax considerations in this and generation skipping things that you have to think about. But ultimately, I just know I'm going to be able to pass it in some way, and I'm getting the benefit of that tax efficiency, that tax-advantaged account structure today. This is what I call off-label uses of accounts. So one of the pet peeves that I actually have in the tax efficiency space is also an advantage or an opportunity, and that is complexity.
You tell me I should have 529? Even though I'm not planning to go back to school?
You could use some further education, so yeah.
He does. Inside P, I am not on taxes, right?
The complexity of the tax code, of the vehicles, we've created incentives for different things, but that actually provides opportunity to be saving for other things at the same time using those accounts.
Now you got me interested here. So what other, you called it what?
Off-label uses.
The 529 is a great one. Other candidates or areas?
Absolutely. Right. So one that I actually didn't even mention with the 529, so I'll start there. Well, under some recent tax law changes, you can use a certain amount of 529 assets to fund Roth IRAs for beneficiaries. So now my kids' Roth IRAs contributions are being funded from their overfunded 529 plan, at least for the next few years.
And going to them for their retirement or whatever.
Similarly, health savings accounts. Health savings accounts that are available for folks that have access to a high deductible or that are enrolled in a high deductible health plan that have significant contribution limits. They're often talked about as, hey, this is what you use to save for paying out-of-pocket medical expenses. But there are a lot of opportunities for longer-term retirement savings by using health savings accounts or HSAs. And in particular, a couple of things. First of all, you don't have to reimburse yourself from a health savings account if you have, incurred some health costs during the year. You can warehouse those receipts and reimburse yourself 20 years later if you want. I can just sort of say, hey, look, I am now withdrawing from my HSA tax-free for those medical expenses that I incurred several years ago.
Really?
Yep.
Wow.
And so you use this as a multi-year savings vehicle. In addition, for non-medical expenses, there is if you withdraw from the HSA, you face a 20% penalty for those amounts, or historically it's been 20%. But if you're age 65, there is no penalty for non-healthcare expense withdrawals. Well, what does that mean?
It just means it's not even.
It means it's a traditional IRA or a traditional 401k. You made a tax-free, tax-deductible contribution when you contributed to the HSA because you have what's called this triple tax-free nature of HSAs. Tax deduction on the way in, tax deferred while in, non-taxed on the way out if for medical expenses. What we do, though, is if you're over age 65, okay, you lose that third leg of the triple tax-free, but that's then now just like what a traditional 401k contribution looks like.
Yeah, so no worse.
So it's no worse than that. So you can use this as long-term retirement savings. The third off-label use that I'll mention is actually Roth IRAs as emergency savings vehicles. You contribute after-tax dollars to a Roth IRA.
Gotcha.
So if you're taking that money out, there's no further tax due. There's no penalty. It doesn't matter if you're under 59 and a half. It doesn't matter if the Roth IRA hasn't been there for at least 5 years. Yes, it might be in your head that you're thinking about this for retirement goal, but let's face it, life happens. There are other things that come up along the way. And if you need access to money in a liquid, non-penalty type way, Roth IRA contributions can be one source of like an emergency savings type account.
How do you get your message out there? How do you talk and educate plan sponsors who may not be aware of all these efficiencies that you've spent a lot of time unearthing for us?
It goes back to this sort of thing like, complexity that is built into especially the U.S. tax code is both a problem and an opportunity in my mind. How do you acquire that little bit of knowledge that can be most beneficial? We did that a little bit with so if I were to do the 80-20 rule kind of summary of this, it's, hey, maximize tax-deferred accounts. And when you want to go to the next thing, go back, have you maximize tax-deferred accounts? And then, kind of think through then the tax diversification element of that because you don't know what future tax rates are going to be.
For me, my key takeaway is diversify your tax risk and also triple tax-free. I will
triple
get into the
tax-free,
HSA. Yeah, I haven't done that.
Well, I think I've been thinking too much on the investment side, Joel, and that's what I'm more comfortable with and less on the financial planning and your tax location. And so I think this has been great.
Joe loves going to cocktail parties and he needs help sounding smart about this tax efficiency strategies. So can you help him out with your one key takeaway, something that he can take back to the party?
I'm an economist. I need help. I'm not talking tariffs all day.
Exactly. The talk of the town.
Oh.
It's very hard.
Here's the problem with that is that I find at those same cocktail parties that people will walk away from me when I start talking about that piece. Yeah. But no, look, I mean, in many ways, you can significantly enhance your returns on your portfolio by being more careful about taxes, whether that might be 1%, 2% a year on average across the portfolio by doing the things like maximizing tax-advantaged accounts, thinking about diversification of your tax risk, and then maybe some of these other things. I will say, though, that where tax efficiency really matters is not so much the investment elements of it. It is the financial planning elements of it. Some of the best money that you can spend if you are going to have money that goes to heirs is a planning strategy that incorporates taxes through an estate plan and so forth in order to maximize the after-tax wealth, both during your lifetime for your consumption as well as for the heirs.
Well, thank you so much, Joel. That's it for today's episode. My goodness, Joel, you've managed to make tax efficiency sound incredibly exciting and actionable. So thank you for joining. If you enjoyed this episode and found it helpful, subscribe and share.